Netflix announced a stock split after the market closed on Thursday, and you may be hearing a lot of things already about how this doesn't really matter. You're still going to own the same percentage of a company. Yes, the number of shares that you hold may go from 1 to 10 or 10 to 100, but the stock price is going to go down by 90%. So basically everything is going to come out in the wash. But there are real legitimate reasons that companies split their stock. So I want to dig through those today. And let's start here with what the details of this split in particular are. This is from the Netflix announcement. And you can see that the company is going to do a 10 for 1 stock split. So meaning you're going to get 10 shares for every share that you have currently. The split is going to be for people of record, or shareholders of record, Monday, November 25th. That is the record date. They're going to actually get those shares on Friday, November 14th. And then the market is going to reflect those changes in the share price on Monday, November 17th. So those are the 3 important dates to keep in mind. Basically, your broker is going to handle everything in the background. There's going to be nothing that you need to do as an investor. On Monday, the 17th, those extra shares are just going to show up and the stock price is going to adjust at the same time. There's also no real way to game the system. I get these questions often when we talk about stock splits. Is there a way to buy shares on Monday and sell them on Thursday and kind of arbitrage things? No, there's not really a way to do that. But what is the advantage of a company splitting their stock? Well, one reason to split your stock, it goes back to legacy reasons. When I started investing in 1995, we didn't have fractional shares available the way that we do today. Some brokerages still don't have fractional shares available. My son has a custodial account with Charles Schwab. Netflix is actually one of the stocks that he would like to purchase. At that time, he didn't have $1,100 in cash to purchase shares in Netflix, and he couldn't buy fractional shares in that account. So it wasn't an option for him to buy shares of Netflix. I didn't move on to a different lower priced stock. So that is a functional reason, but that's more of a legacy reason. Most brokerages today do allow you to hold fractional shares. So you can put it in an order and say, you know what, I want to buy $500 of Netflix stock. And then you will just buy 0.45 shares of stock or whatever the numbers end up being. Now, the more functional reason really comes down to liquidity. And this is getting to the market functions. If you look down here, this is on Yahoo Finance and the market is closed as I'm recording. So these numbers are not going to be accurate compared to what they would look like while the market is open. But you see these 2 numbers here. But the bid is going to be, this is what you, as someone who may be looking to buy or sell shares of stock, this is what you could sell your stock for. The bid is what someone else will buy it for. The ask is what you are going to have to pay if you want to buy shares. Now, right now, this spread, the difference between these 2 numbers is really wide. That's because the market isn't open. So this is probably where late trading or after hours trading ended the day. So more than $100 spread. Normally, with a stock that's $1,000 to $1,100 per share, you're going to see a spread that may be 5 cents, 10 cents, it may even be $1. So pretty big spread. So one of the reasons to reduce your share price is to reduce that spread. If you have a share price that's between $50 and $60, let's say, it's likely, especially with a company as popular as Netflix, that has as much trading as Netflix, that you're going to have a very, very low spread, potentially even a penny. So the difference between where you can sell the stock and where you could buy the stock is going to be a penny. As retail investors, we're always going to pay that higher price and get the lower price. Market makers are going to be on the other side of that. They can basically get paid to provide that liquidity in the market. The other piece of this is how much depth there is in trading. And you see this times 100 here. That's because a standard lot is 100 shares. So if you're a market maker, and there are thousands of market makers out there, there are huge firms like Citadel that's a huge part of their business. There's hedge funds that make markets. So they're just trying to make this penny spread or 5-cent spread between stock prices all the time. So that's why when you see stock prices moving throughout the day, they're the ones that are involved there. You're likely not buying or selling from somebody who has been holding the stock for the last 10 years. It's likely a market maker that you're actually making a transaction with, but they're going to put in 100 share lots is what they're called. So if you're going to put in a bid to buy 100 shares of Netflix stock, that's $100,000. Same thing on the selling side. If you're putting in an ask what you would actually sell your shares for, and you're going to have both a bid and an ask, that's another $100,000. So that's $200,000 worth of liquidity that you have in the market. And you're likely going to be trading these by the second. So there's going to be millions and millions of dollars in liquidity just in Netflix stock that you're going to have to provide if you're a market maker in this stock. It makes it very expensive to make a market. If you reduce the share price by 90%, then it's going to be much easier to provide liquidity. Now that number goes from $100,000 to $10,000. So the depth of liquidity will likely increase with the lower share price. Those are the real functional advantages on a day-to-day basis. You're going to get a lower spread and more liquidity in the market because simply the share price is lower than it is. And these market makers are putting in round lots. The other thing that you're going to see is a change in options pricing. So right now, I'm looking at the about a month out options. So November 28th, 2025, and we're just looking at call options If we go all the way down here to at the money options, these were trading for $36. Now, an option, every one of those contracts, one single contract is for 100 shares. So the price for these options, whether you're buying and selling, and again, this gets to the liquidity piece, but even if you just want to buy one contract, that's $3,700. That's a pretty big investment for just one simple contract. So if you reduce the share price by 90%, now this is going to go down to something like $3.70. That's going to make it much more likely that people are going to trade options, provide more liquidity. On a short-term basis, this does a lot more for price discovery and allows investors to put on different trades. Now, as a long-term investor, a lot of these things don't really matter to me. Having a slightly smaller spread isn't that big a deal if I'm planning on holding the stock for 10 years. Having more liquidity on a day-to-day basis, a minute-to-minute basis, isn't all that big a deal if I'm planning to hold a share for a long period of time. But for functional markets, this is the reason that they're doing these kinds of things. Lowering the price increases liquidity, gives you more access to buyers. And one of the things I always like to go back to is something Sam Walton says. This is when Walmart announced its recent 3-for-1 stock split. And one of the reasons their founder, Sam Walton, believed in keeping a relatively low share price is because he thought it was important to keep a share price in a range where purchasing whole shares rather than fractions was accessible to all of their associates. So there is a psychological element. If you own 0.001 shares of Berkshire Hathaway, that just doesn't feel like you have the same ownership as if you have 1 share or 10 shares at a much lower stock price, even if you may have the exact same percentage of the company in your ownership. So yes, it is technically true that nothing changes when a stock price goes lower when a stock split happens, but there's a reason that stocks typically move higher when splits are announced. And some of the reasons come down to market mechanics, some of those are legacy reasons, and some of them are simply psychological. So hopefully this is helpful in understanding why Netflix is splitting their stocks 10-1. Let me know what you think in the comment section below. And of course, don't forget to subscribe to Asymmetric Investing here on YouTube and also my newsletter. There's a link on the screen and a link in the show notes. That's where I'm building a market beating portfolio. Love to have you as part of that community. Thanks for watching, everybody. See you here next time.